TheoTrade. This is Don Kaufman. October 21st, 2022. Just about 25 minutes left in this trading week. Some fairly wild action today to the upside. But the big question on everybody's mind, did bonds hit the point of no return? I don't know, explain exactly what that means. Or, hey, maybe you're just seeing degrees of capitulation in the bond market. All right, let's get right down to business here in this weekend's update. So the S&Ps, as I said a moment ago, with 25 minutes left in the trading session, they are ripping. But right off the bat, and this is going to be a very controversial statement that I'm about to make, it's all for nothing. Who cares? The S&Ps are up. No, it's 2.4%. Listen, price action in the S&P 500 at present time, it's just a volatility slop fest. We have not broken the range. And I know that this is where everybody goes, no, it's a magnificent rally. This is absolutely nothing. Again, it's all for nothing to see the price action to the upside. I mean, the only thing you can state over here is that volatility is alive and well, which I'm going to mention again here in a couple of moments. But again, price action in the S&P 500 is nothing more than just a huge volatility slop fest. Let me actually make a case for that before anybody flies off the handle just yet. So I'm going to cruise over here to the S&P 500 futures, the SPOOs, and I'm going to cruise over to the 30-day 1 hour. Listen, I have been talking about this range now for weeks. It's what, I term a volatility box. So I'm going to go ahead and display exactly what that volatility box amounts to. Here we are as we dropped into the volatility box. What does it basically run from? Oh, 3,600 right into 3,800. One of the most amazing things is you realize how far the S&P futures have moved today, how far they've actually moved in some previous trading sessions, but we're not getting anywhere. I mean, look from like low to high today inside of the S&Ps. It's just downright shocking at this particular point in time. Again, I cannot stress this enough. When you have a low at 36.41, we're towards like kind of the lower edge of the volatility box, and here we are. Now you're like, oh, we're almost to the upper edge of the volatility box, and that's why I just argue it's all for nothing. Just the other day we were trading very close to here. We actually touched down to the lower edge of the volatility box, only to touch exactly where we are right now. So again, it's all for nothing. I want to explain exactly what this price action kind of amounts to. Once again, though, one of the things that's so imperative to understand, first and foremost, we've been in this box now for what? A month. It's actually, today it'll be officially a full month. I mean, we dropped into the volatility box again in kind of like mid to late September. Here we are again, 200 point range. As I've been reiterating each and every week here, video after video, I'm just like, this is the range that's just going to define us all, because all we're doing in here is just building and building and building and building open interest inside of the SPX, inside of the spiders. And that's the point I was making on last weekend's video, the point I was making on Wednesday's video. As you start to accumulate all this open interest, again, I don't care that we're up here. Until we're through 3,800 and exploding to the upside, don't even bother calling it a rally. Because again, as I said a moment ago, we've been here before. We were down here the other day. What a difference 5 or 6 hours can make, right, in the marketplace. Nevertheless, all right, the point being over here, we're still in the box. What's in the box? We're in the box. And it's completely and utterly binary move. That's the other key takeaway over here. When I say it's a binary move, listen, you're a coin flip away of trading, to the upside. Well, how far to the upside? If we do explode to the upside, the first marquee level would be 39.31. That's actually one of our gravity points, would be 39.31, which is right in this handle here. To the downside, well, to the downside, if we are to break to the downside, your guess is as good as mine. We have a number of catalysts coming, of course, this next week. So if you've looked at the calendar, there's some GDP numbers coming out, obviously, this week. We also have earnings. Oh, that's going to be exciting. Everything from like Microsoft to Apple. Talk about that in just a brief moment as well. So again, we're still in the volatility box. And, beyond that, when it comes to like, price, direction, bias over here, do I have one? Again, the bonds, the bond market, which we're going to talk about extensively here in a moment, lends itself to the fact that, hey, I think I have to be surprised at this point to see the S&P is up with the bond market. It's getting killed. I mean, to say that here, it's getting absolutely destroyed in the bond market. I am a little surprised to see the S&Ps up. Then I think to myself, all right, there's just a ton of gamma risk. Okay, we're ripping to the upside. But as I said, until we've actually cracked the range, it's all for nothing. And I really wouldn't get too excited about some of the price action that you're seeing in here. And it really doesn't matter like what product you look at. When you start looking at like, the financials, oh, look, they're all boxed out too, right? Just take a look around a couple of sectors, right? So at that box, there's one trading day that exceeded the box to the downside. Everything else is pretty much inside the box there, inside of the financials. I mean, you could start looking at like monsters of tech. What are the monsters of tech? The big boys of technology. What do you have in there? Oh, it's almost perfect in there as well. Anything that matters for the most part is inside that volatility box. And that's just the bottom line. In fact, of course, you want to bring up the Nasdaq a little bit and bring this to a 30-day 1 hour. Okay, the Nasdaq is even kind of more wild, and they did have some highs in the Nasdaq early on, but the Nasdaq volatility has actually died down quite a bit in terms of channeling back and forth. Look how wild though some of the movement is, roughly from 11,400 to 11,000. We're just oscillating back and forth, and it's been vicious. And that's one of the things to have some respect for, because again, the longer you're going to channel back and forth, the more explosive the move is going to be when we come outside of that box. But for me, at this point, do I have any greater fear of breaking to the upside than the downside? Absolutely not. I mean, you could still make a great case for the fact that no one's in here really buying, right? When I say no one's really buying, yes, there's a ton of short covering, but no one's in here like, wow, I really got to put my money to work right now in Snapchat. Like, no one's going out there and putting like new capital to work. How do you know that? Because if they were, we'd explode, right? I don't mean all the way back up to 4,100, but I'm saying we'd explode right outside the box over here. At this point, all you have is, there's some shorting, there's some covering, there's some oscillation back and forth. Again, that's why I call it price action. In the S&P 500 is the volatility slop fest. We're still stuck in the box, which is 3,600 to 3,800. The other aspect that really, this reeks of volatility because the correlations remain incredibly high. It's like, if there's like the hallmark of volatility, yeah, here it is. You're like, oh, what's down today? Anything with earnings. Verizon had earnings. Okay. By the way, speaking of Verizon, this thing's getting killed on a year-to-date basis. I was talking about this a couple of weeks ago. Run from low beta stocks. Verizon happens to be, I want to say off the top of my head, it's like a 0.37 beta. Take a look, just a quick glance at it. There it is, 0.37 beta. And if you take a look at the year-to-date on here, it's down about 32%, but I think it's a 7% dividend as well. So the dividend yield is up. And again, this actually goes to something I was mentioning a few weeks ago about like XLU, still getting absolutely hammered, but definitely off some of the lows over here. Again, the dividend in there now down to about, just about 3%. Anyway, onward and upward. So again, one of the things I really want to emphasize in this weekend's update is stop reading into price activity. Like there's nothing to read into right now. Binary. You're a 0 or you're a 1, right? You're going to explode to the upside, you're going to take off to the downside, and there is no in between. Okay, so there's still some huge signs of volatility. Obviously, we have the correlation coefficient being incredibly high. The VIX, let's actually cruise over to VIX. VIX is also really bothersome. Why? Have you looked at VIX? Well, today. How many times have you seen the S&Ps up 2.5%, but the VIX actually higher? Okay, does that actually scream to you, yeah, I really want to get involved in that? Okay, this is dangerous. It's very dangerous, not because just the VIX, and please bear with me on this front because I'm just not a VIX kind of guy. I always say this is my predecessor's volatility indicator. I look at the vol futures, and when I look at the volatility futures, I look at like VVIX and so forth. But I look at vol futures. Hey, like who are you kidding over here? You're still in backwardation. So before you start high-fiving one another, that 26-day is still above the 61-day, which still reeks like, hey, we're in the middle of like something very, very serious. But I cannot stress to you enough, there are a handful of days in history where you're going to see a 2.5% move to the upside in the S&Ps with volatility basically unchanged or even slightly higher. Handful of days in history. Okay, if there's a warning shot to be fired across the bow, it's that. I'm kind of the opinion at this point, and by the way, I'm still carrying some bearish positions, but I'm of the opinion at this point, this is dangerous. Even if we do crack the upside of the volatility box and we come up to 39.31, we can come off like a rock. Like, we have got to get normal. What's normal? You got to drop this correlation. Like, you want to get bullish in the marketplace, you got to see the correlations cool off. Like, this is insane. The market's moving as a unit. No one cares what stock you have. But my Apple. No one cares. Like, no one cares what sectors you're in. It's just, it's a complete free-for-all inside the box over here that we're just bouncing back and forth like a pinball, literally going back and forth. But the VIX still holding at the 30 handle. Like, oh yeah. I mean, again, because we haven't really rallied. I know you're going to make the argument, no, we're rallying. Really? Because we moved from what, 3,600 to 3,766. Okay, guess what? Again, we were at 36.41, and that was just a few hours ago. I mean, it's that chaotic right now that you're seeing right before the cash open. Yeah, 36.31 to a straight shot to the upside, which is actually, when I say in the literally the next bullet over here, volatility is alive. It's alive and well, 36.41 to infinity and beyond. Except there is no infinity beyond. The only beyond would be beyond 3,800. So again, signs of volatility everywhere inside of this marketplace. That's one of the things. Again, key takeaways here obviously are no directional bias right now in the S&Ps. If you have one, if you start to really position yourself heavily bullish or heavily bearish, okay, you can get absolutely run over. This is a time where, I'm still carrying negative deltas, but again, I've wrapped my deltas a little tighter. Okay, that implies that, I could have the greatest feel in the world, but I've actually seen this movie before, and it doesn't matter, right? Like, the market's not going to care. It's going to use some like exogenous event as a catalyst. It's going to explode higher, or it's going to come off huge. You don't know if that's going to be Apple's earnings this week. It could be Google. It could be any of the earnings. It could be GDP, right? All you're sitting on right now, okay, is a powder keg of risk. That's all you know. Okay, who's going to light the fuse? Oh, I don't know, but it's going to be exciting out there. Okay, now let's get down to business, because bonds. I have some deep, deep concerns for bonds. And the interesting thing for bonds is, most of the time when I'm actually doing these weekend updates and so forth, I'm talking about price action kind of in the here and now. The bond implications, though, this is almost too many to even mention. One of the first things I want to start with, because a lot of people are not necessarily familiar with the bond product itself, like ZB. Like, ZB doesn't make a lot of sense to a lot of people. It's, this is the bond futures contracts, and, they've traded here to here, but I think the TLT makes a lot more sense. And we'll talk about some of the yields, the interest rate, associated with that. Again, one of the implications of what we term is these spiking yields is just, it's horrendous, and we're gonna look at that. But the first thing I want you guys to look at, here's TLT. This is a 9-month chart. Let's actually go year to date. Year to date, okay, the TLT, which is representative of the 20-year. So it's kind of a blend between the 10 and the 30, right? It's down 35%. Have you been in a situation before where the bond market, okay, and its losses have actually exceeded, if you will, the S&P? Let's bring up the spiders for a second. Spiders are down 21%. Obviously, Nasdaq is down 31%. Okay, the implications of this, as I said, they're deep. They're extraordinarily deep, and this is where I start to draw some comparisons, if you will, for just a moment, to the financial crisis. And when the financial crisis hit, everybody felt immediate impacts. The layoffs were huge. You saw the housing market was absolutely, in crisis. The banks were in crisis. But the biggest crisis, okay, at the moment was the S&Ps were absolutely getting annihilated. Everybody saw their 401ks go down. I'm going to make an argument. This is actually, albeit brief, but I think the implications, the bond market could actually be far more dire at this particular point in time. And it doesn't have to do with Wall Street. It has to do with Main Street. And I think the effects of this are going to be felt for years and years to come. And it has to do with this. Like, again, we'll talk about the possibility of capitulation of the bonds in a moment, but the implications of spiking yields, okay, are, as I said, there are going to be many of them. The way to actually describe it to you, you can say spiking yields. Here, let's go to the TNX. The TNX is the 10-year Treasury, okay? And I'm just going to write this up here. So for those of you who don't necessarily look at some of the yields, right now, I know this says 42, but it's not to be read as 42. What this implies, okay, is 4.2%. And that happens to be on a 10-year. The 10-year is unequivocally the most important on the, if you will, kind of the retail side of things, us being retail clients and the consumer, because the 10 years, everything from mortgage rates, yada, 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 I can go on for a half an hour. Then we can actually talk about shorter term yields. If you want to take a look at shorter term yields, we can actually jump over to Tastyworks. Tastyworks, take a look at the, here is the, again, the 2-year. And the reason I'm bringing up the 2-year, that's actually at about 4.47. The reason I'm bringing that up is because that would be a little bit more akin to some of the credit card debt. Like, listen, you are you're a consumer in every way, shape, or form. On one side of you, okay, you've actually got yield squeezing you, and the other side, you've got inflation. You're basically going to be caught in the middle. It's just, you know, you're going to be at 4.5% maybe on the 10-year, inflation on the other side, credit card debt exploding in here. There's nothing good that I can mention on here. And again, implications of spiking yields, you know, you be my guest, and that one's not gonna just, you know, jump out overnight. It's this is actually going to erode, you know, the consumer, which starts to bring into question a lot of the retail stocks. All right, so when I start thinking about this, start looking at, like, you know, the targets and so forth. Look at stuff like Target, year-to-date percentage down about 31%. I don't think that's actually going to be, you know, the implications are not deep enough over here. Stuff like Walmart, it's only down about 5%. Looking at stuff like Costco, down about 15%. I think there's going to be some, you know, what are still stocks that are holding up relatively well that can get absolutely annihilated in here. Everything consumer credit, housing markets. If you take a look at specifically the XHB, the damage inflicted to the XHB, if the year-to-date percentage is down about 35%, ironically, that's almost exactly what it was inside of the TLT. Nevertheless, there could actually be considerable more sell-side activity over here because we haven't seen the erosion yet. And the single biggest erosion could actually be in buybacks, stock buybacks. So let's move away from what I would term Main Street, which is all of us, and talk back, you know, into take it back into Wall Street, and you look at buybacks. One of my biggest concerns coming into this earnings announcement, again, it's pretty much go time for earnings coming out. All right, are anybody actually going to put some of their stock buybacks on hold at this point? Has the market done enough damage and interest rates gone up enough where, you know, someone big like a Microsoft, like an Apple, like an Amazon, okay, actually go out there, like, you know, obviously Facebook. I mean, the implications, just Facebook, I mean, this thing's already down 61% year-to-date basis, but those implications could be absolutely massive, okay? There are too many to even bother mentioning. One of the reasons, though, that I'm bringing this up, and I want you to see, and now we're going to talk a little bit about some of the price action in here is, okay, as I said, the implications of the bonds just crashing, and it's been an outright crash, and down 35% year-to-date basis in the TLT. There's no other name for it, right? The implications are going to be long-lasting, and that is one of the biggest and most significant takeaways, because if you ask me right now if the S&P's bottom, because I want to relate this back to the S&P's, you know, I'm going to ultimately laugh a little bit and say, absolutely not. How can they possibly have bottomed? We haven't even seen the beginnings, if you will, of the implications of yields rising so much on the on consumer. And it's one of the things, again, car loans, I can go on for a half an hour of all the implications of spiking yields that have yet to be felt. You know, if you asked me a couple of months ago, I'd have been like, yeah, it's 6 to 9 months out. You know, those Fed rate hikes are really going to take hold. Yet now we're anywhere from 2, maybe 5 months at most out in time before we're really going to start to feel the implications of, again, spiking yields. Okay, with that, you're going to start to hear, I believe, many stocks, not necessarily this last quarter, but there's going to be warnings coming out. And again, this is something we're going to be looking for, not just in big tech, but through and through in some of the earnings announcements that are going to be coming out. The other major concern in this week of trade, has anybody here been looking at the currency markets? Because if you're not, you're missing something huge. Look at the volatility back and forth inside of the US dollar. It's not the US dollar that really has caught my attention. You know, I can also bring up, of course, you know, like British pound. Clearly, there should be some volatility here with the resignation. There, again, even today's trading session, if you take a look at the British pound, wild move back to the upside, but also big cause for concern over here. That's real. That's actually the Japanese yen exploding back to the upside. Again, the implications of this are far-reaching. You might look at some positive and/or negative implications. Nevertheless, okay, this is It's going to be currency intervention at its best coming to a theater near you. All right, I want to push that one aside for a second because I got to tell you right now, when it comes to currency volatility, I don't have a great feel of the implications of that moving forwards, the S&Ps, other than to say, what? If you think that the S&Ps are volatile, you start looking at currency products and you're like, wow, okay, this is just spellbinding. Speaking of currencies, while I was down there in the bottom of the screen, there's one other point that I wanted to make about a rally and or a sell-off. And it didn't have to do with British pound. It didn't necessarily have to do with the Japanese yen. It had to actually do with crypto. Take a look. If you think real money is being put to work in the marketplace, I'll think again. See, there's not a lot of short, okay? There's not a lot of shorts inside of many of your crypto and crypto-based products. It's very, very difficult to go out there and to generate short positions, okay, in stuff like Bitcoin, even Bitcoin futures. You can absolutely generate short positions in here. Nevertheless, one of the things I want to mention is you just don't get a tremendous amount of shorting inside of products like this because you don't have any shorting. Okay, you also don't have the wicked rip your face off rallies. Okay, this right is indicative of, again, a marketplace. Nobody wants to put any capital to work. All right, back over to the bond product here for just a moment. Reason I'm going back to bonds, okay, before we talk a little bit about some of the earnings. This is what capitulation could possibly be made of. So there's a humongous spike in volume in here. And actually, this is one of the largest spikes in volume inside of the TLT that we've seen. The other thing that really resonated with me today, to go to study, go add study, go to volatility studies, go to implied volatility. There's a pretty significant spike up in terms of implied volatility. If there are degrees of capitulation going on inside of the bond market, we're close. Nevertheless, I think that the implications moving forward is the damage is already done, meaning the yield's already spiked. It is what it is. But we may actually get a bit of a short-term bottom inside of the bond market. This could actually be due course for a just a ripping rally. The only problem with that is, where's the capital going to come from? So we may see a reversal of markets, and it's why I'm bringing it up. Because if the bonds hit the point of no return, that just basically means the damage is going to be inflicted. It's going to be inflicted over a significant period of time. But I'm going to give you an interesting argument. If capital's to come rushing back in to the bond market, no one wants to put any new capital to work. It very well could come out of the S&Ps. You could be back in a situation where you're seeing capital flows from S&Ps back in the bond markets. Be on the lookout for it. I'm serious. That could be wild moves coming to a theater near you. Last but definitely not least, as I said, there's a lot of announcements that are going to hit the tape this week. It's going to be earnings go time. Okay, it is what it is. So earnings are going to come out, GDP is going to come out. Okay, listen about stock buybacks. That is, again, the single largest concern for me. And of course, okay, we end every single weekend update talking about the mother of all products. There's 2 minutes left in the tape. S&Ps are up just about 86 handles. Check this out. We breached to the upside. We're going to end the week outside the expected move. Why am I bringing this up? Listen, I'm bringing this up because this week of trade, right, the one that we're just coming out of, we had plus or minus $120 move priced in. How big was the move today? Look, we moved from 36.40, okay, to 36.70. So when we're talking about the whole week was supposed to have about $120 of price action, you had that today. That's in the S&P futures. You had it today. You had me at today. And then you start looking out to next week, okay? The S&Ps, again, are doing a horrible job handicapping risk. If you look out to next week, the expected move is not set just yet, okay? We just came off this $120 expected move. We smashed through it. Now we're coming into next week, and we only have $115 expected move. What gives? What gives is, okay, markets still completely and totally getting ripped apart. They are unsettled right now. Well, keep your hands and feet inside of the vehicle at all times. It's going to be a rough ride the next couple of weeks. It doesn't matter. Again, it doesn't matter. We smashed to the upside. The reason I'm maintaining, okay, negative deltas, that is a bearish stance, it's because the implications of the bond market. The bonds, doesn't matter if they hit the point of no return, doesn't matter if they hit rock bottom. Damage is done. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.